Reserve Bank of India has proposed creation of a Historic Financial Conditions Index, that is FCI. Now, in an effort to enhance the real-time monitoring of the financial health of our country, RBI has proposed of creation of this Financial Conditions Index, which will be giving data in relation to the financial health of the country in real time and also with the daily frequency. Now, in order to enhance the real-time assessment of the financial health of the country and country's financial ecosystem, the RBI has proposed this particular index with the daily frequency chart, and also it is a composite indicator. Composite indicator means it is an indicator with a lot of aggregates data from a lot of different sources across major financial segments of the country to evaluate how tight or stressed economic condition or financial condition of a country is relative to their historical average, and that historical average will be taken from the year 2012 onwards. Now, this particular move of RBI aligns with the global banking norms, the central banking practices, and with this particular FCI, it will help the country or help the RBI to gauge how successful monetary policy transmission is there in the country. It will also help in taking informed policy decisions, both for the RBI, for the government as well, and it will also help signaling any systematic stress in the economy, in the financial sector of the country, so that remedial steps can be taken beforehand until the time crisis is reached to, we are able to anticipate the crisis and solve the crisis even before it develops and turns into a crisis. Which is why, in order to understand the financial health of the country, this particular indicator is very, very important. Now, what are the nitty-gritties of this financial conditions index, how it is linked to the entire financial market of the country, and some terms in relation to the financial markets, which as a common citizen you should know, we'll be trying to discuss in this particular session. Hello, my name is Preetpal Singh and you're watching Perspective. Now, firstly, I told you that this is a financial conditions index, which will tell the condition of the financial market of the country. Now, let me very briefly explain to you what is this financial market. See, any market which is having two players, of course, one who's having deficient funds and one who's having excess funds, if a market is created between them where exchange of finance takes place, it is known as financial market. Now, there can be different and varied spectrums of financial market. We broadly divide the financial market into two types. One is money market and one is capital market, and the difference is just very simple. If there is financial instrument which deals in trade of finance from one party to another in a short term period, which means a period which is less than 1 year, it will be part of money market. But if it deals with money or finance whose duration is more than a year, the duration of transfer is more than a year, it is part of capital market. Now, there are different money market instruments which go on. One is treasury bills, which is also known as government securities, short-term government securities. That is treasury bill. Other than that, there is commercial papers, there is call money, which is also known as interbank money. There are bills of exchange or the loan given by the commercial bank for short period, that is less than 1 year. All are part of money market for a country. And money market is a part of the financial market of a country. Now comes capital market. Now, capital market includes instruments whose maturity is after a period of 1 year, that is after 365 days. Now, this might include debentures, which are privately issued by the companies. It might include government bonds or corporate bonds as well, which have longer duration maturity periods. So, the government bonds which we see, they are a part of the capital market of the country, or the loans given by the commercial banks, loans issued by the commercial banks over a longer period of time also becomes a part of the capital market. Now, other than that, these are the debt instruments. One more part of the capital market is equity instrument, which is the shares which are issued by a company. So let's say I own a company and I want to raise funds for my company. I will issue certain percentage of ownership of my company to the general public. And when public subscribes to the ownership of my company, I give public one individual ownership paper, which is known as a company share. So company share or shares of a company is one part or percentage of ownership of a company, and which is a part of equity. So these shares is also known as equity. So capital market consists of your debt instruments, which are debentures, which are commercial bank loans, which are bonds, and it might also include equity, and equity involves issuing of shares by a company. Now, all these things, whether it be money market instruments or capital market instruments, they are part of a financial market of a country. Now, since you have an understanding of financial market of a country, you'll be very easily able to understand what is this financial conditions index. This particular financial conditions index, all the metrics which we just discussed, it will observe all these metrics. it will integrate data from all these metrics and will tell us in real time how is the financial health of our country. So basically, it would be a financial barometer for indicating financial stability of a country by integrating different layers of data, whether it be from money market or government securities, corporate bonds, equity market or foreign exchange market as well. It will integrate the data from all these different layers and it will give in real-time basis. It will show in real-time basis that how each of these particular instruments are performing and what is the financial health of the country. That is our financial conditions index. Now, according to the study which was published by RBI in this June 2025 bulletin, it highlights that the purpose of this financial conditions index is threefold. First purpose is to measure the ease or tightness of the financial sector of the country or the financial conditions daily on real-time basis. So daily it would measure that is the financial stability or financial condition tight or is it at ease. That is the first purpose. Now, second purpose is to capture various trends. Now, trends across calm and volatile phases inside the country on different financial instruments and financial indicators. So, for all the financial indicators, the purpose of this financial condition index is to give us and capture the trends in the market. And if we capture the trend, we'll be able to anticipate if in future there might be a crisis which is coming. And also last but not the least, it will help the policy makers to serve as a macro financial surveillance tool. So policy makers will use it as a macro surveillance tool, a macro financial surveillance tool, which will help them in surveillance, real-time monitoring and surveillance of the economy, and also to take remedial measures if or may any crisis might come in future. And if I have to tell you precisely, this financial conditions index, it is actually made on 20 macroeconomic indicators or market-based indicators, and also their values are standardized in order to reflect the changes in the financial tightness or looseness in a standard deviation units. So standard deviation, which is a very integral part of the statistics, in standard deviation units, the numbers can vary from plus 0.1, plus 0.2, minus 0.1, minus 0.2, or plus 0.1536, something like this. Numbers like this, which we see usually in standard deviation, could be seen over here. And also, how do you see this indicator? See, a positive value in this financial conditions index would highlight tightness in the economy, and a negative value would highlight easing conditions in the economy. So usually we say expansionary or contractionary policies. Expansionary policies or loose policies would be seen with a negative indicator, and with plus indicator you would see tighter conditions or contractionary policies. Now let us try to apply this financial conditions index in the last 10-15 years. So we all remember that the era of 2010, 2011, 12, 13, 14 in the global world, holistically in the global economy, it was the era of tightening, financial tightening. Why? Because after 2008 global financial crisis, there was huge macroeconomic surplus, huge monetary and fiscal surplus, huge stimulus given to the whole economy. And after that, it was the era of tightening, which is why in 2013 we saw taper tantrum in US. After that, we saw the crisis of non-performing assets, bad debts, and twin balance sheet problem in our country. And after that, there were problems of fugitives, economic fugitives in our country, which left our country owing thousands and thousands of crores to our country. That was one problem. Other than that, there were ILFS crises or different other banks shutting down and being merged with SBI. Those crises were seen. And after that, there was demonetization and then GST. So all this era could be called as the era of financial tightening, where prudential norms were implemented by the Reserve Bank of our country. So that era of financial tightening, in that particular era, the financial conditions index reached to the peak of a positive 2.826 points of standard deviation. That is the financial condition index. And after that, during COVID, of course, there was tightening, a lot of tightening. But in response to recover from COVID, there was a lot of monetary easing in the economy. A lot of money was pumped into the economy. Until now, it is being pumped in the economy. Because recently we have seen that in the last many monetary policy committee meetings, RBI has done just one thing. It has provided and it has fueled liquidity into the economy. It has injected liquidity into the economy. Whether it be reduction of the repo rate in the economy, whether it be reduction of the CRR, cash reserve ratio in the economy, RBI has tried to inject and enhance and improve massive liquidity, which is an era of easing. And after COVID, of course, due to a lot of stimulus packages, we saw huge financial monetary easing in the economy. And if we talk about the early COVID period, when we just started recovering and when all these measures just started taking place by the central government and by the RBI as well, our financial condition index reached as low as minus 2.197. as of June 2021. So this negative point shows ease in the financial market, that at that time financial market there was ease, there was liquidity, there was a lot of money. But in contraction in the financial market, when there is tightening of the financial market, we see a standard deviation of positive number. I hope by now you are able to understand this financial condition index in a fair bit of way. Now the logical question which might be striking your mind is that what is the purpose of it? See, the purpose of it has already been stated by the RBI, which I told you with respect to the policy guideline which RBI, or the study published by RBI as of June 2025. But other than that, if we see this index holistically, so the way India's macro financial indicators are analyzed, it will pave a new way for it. It will help the researchers, it will help the policymakers, it will help the students as well to understand our economy in a fair bit of great detail than before. So one thing is very clear, it will help in real-time monitoring. It will enable identification of any stress which might be building up or any excess exuberance in the market, in the financial markets. Other than that, it will help in policy calibration, policy analysis, and also it will support timely and data-based monetary and fiscal policy decisions. So the fiscal policy and monetary policy, it could be even more effective, and monetary policy transmission could improve to a great extent. And other than that, those who are participants of the financial market, whether it be of the money market or the capital market, they can use this particular index as an analysis tool. And it will offer insights to these financial market participants regarding the liquidity and the systemic risk in the particular market. So it will help them, the financial market participants, also in a great detail. Now globally also, this financial conditions index has been used by major countries, whether it be by US Federal Reserve, whether it be by European Central Bank or different other developed nations as well. And for India also, this FCI will definitely help in improving monetary policy transmission, will give a better outlook to the financial health and financial indicator of a country, and will cater to our unique market dynamics as well. See, over the last 10 years, because of digitization and now due to advent of artificial intelligence, we have seen the financial landscape and the financial market altering day by day to a very great extent, and it has become very dynamic as each day passes by, and the financial architecture is becoming increasingly more complex. And in this particular complex financial architecture, to understand and measure the financial health of a country, this financial conditions index plays a very pivotal and major role. Also, it offers a unified, real-time, multiple market segment data, and it empowers both policymakers and the market participants as well, which is why it is of great use. Now, what is required is continued refinement of this particular index. Alongside this, what additional to that is required is including more metrics to make this particular index more robust, more indicative of the current realities, contemporary realities of the financial sector, and also so that this index helps our policymakers better in making fiscal policy and monetary policy and improving the outcome of the fiscal and monetary policy, so that the real lives of the people could be impacted in a better way. This index is very vital and needs to be consistently improved over every single year. So the eventual role of this index should be to cater to the masses of our country, so that each and every individual's life could be impacted in a better way through this index by the monetary policy or fiscal policy or any other decision taken by any lawmaking body in relation to economics and finance. So this index might be a breakthrough and might be a revolutionary step in indicating and in analyzing the financial health of a country and financial performance of a country. I hope you gained a new perspective from this session and you got to know new terms in relation to the financial sector as well. Do let me know what are your views surrounding this index in the comment section, and what could be done to make our monetary policy transmission even better. Please let me know in the comment section. I'll be very happy to know. All the very best and have a beautiful day. Thank you.